Okay, so how do you take just this huge pile of financial reports and, strategic plans, earnings calls, all of it,
Mm.
and actually turn it into something clear, something you can act on?
Yeah, it's like trying to find a map, isn't it? A reliable map in this just sea of data.
Exactly. So today, we're going to embark on a deep dive. We're looking at Poonawalla Fincorp Limited, specifically their latest performance and strategic moves for Q1 of financial year 2026.
Right, so that's covering April through to the end of June 2025.
And our mission, really, for you listening, is to navigate through all their material, the investor presentations, press releases, the earnings call insights.
We want to pull out the most important bits, those nuggets of knowledge, and kind of connect the dots for you.
Yeah, so you walk away feeling properly well-informed about this company. They talk about building a sustainable, predictable, productive business, and we want to see what that actually looks like.
Definitely, whether you're, prepping for a meeting or maybe just catching up on the financial sector, or maybe you're just curious, frankly.
Right. We're here to hopefully give you those aha moments, make sense of it all without feeling overwhelmed.
So, yeah, let's get into it. Let's unpack this.
Okay, so kicking things off, the big picture for Q1 FY26. What are the headlines?
Well, first up, their assets under management, or AUM. It grew really robustly. We're talking 53% year on year.
Wow, 53%.
Yeah, and 15.8% just quarter on quarter. So it reached 41,273 crore. Quite impressive.
That's a significant jump. It really points to strong momentum, doesn't it? Like their strategies are hitting the mark in the market.
Absolutely. And beyond the AUM, their net interest income NII, which includes fees and other income that came in at 768 crore.
Okay, and how does that compare?
That's up 13.6% compared to the same quarter last year. Profit after tax, the PAT, stood at 63 crore.
Got it. But there was also some pretty significant strategic news this quarter, wasn't there? Something about capital.
Yes, exactly. That was a big one. The board approved raising around 1,500 crore
Okay, how are they doing that?
through a preferential issuance of equity shares. And it's going to their promoter, Rising Sun Holdings Private Limited, at a price of 452.51 per share.
Right. And the thinking behind that, why now?
Well, it's pretty critical. I mean, yes, it strengthens their capital base, obviously, but it's more than just funds. It sends this really powerful signal, promoter confidence in the company's long-term potential.
Ah, okay, like doubling down on their own bet.
Kind of, yeah. It gives them a really solid foundation to back up those ambitious growth plans they have. And just as a note, post-allotment, the promoter stake goes up just slightly from 62.46% to 63.99%.
Okay, so it's a vote of confidence and also fuel for growth. What I find fascinating, and it seems to underpin everything they do, is this risk-first philosophy they keep mentioning. They really emphasize managing risk over just chasing growth at any cost, even if it means, tweaking numbers in the short term.
It absolutely sets the stage for understanding their asset quality, their product mix, everything really. And this quarter, Q1 FY26, it actually marks a full year since they started executing the building blocks for their big strategy.
The solidify, expand, and scale one.
That's the one. And the focus consistently seems to be on, well, balanced AUM growth, yes, but also sophisticated AI for risk calibration and really diligent management of credit costs.
Okay, let's pull back the curtain on the numbers themselves then. That 13.6% year-on-year growth in NII, net interest income, that sounds positive. Revenue's going up.
It is.
But the company also mentioned they expected their net interest margins, NIMs, to moderate a bit. Why? What's driving that? Seems like a trade-off.
That's a really good question, and it ties straight back to that risk-first idea we just talked about.
Okay.
The moderation in NIMs, it's mainly because they're deliberately recalibrating the portfolio. Specifically, they're transitioning their older STPL book.
STPL, secured term personal loan.
Correct. That was a higher yield book, but maybe, carried a bit more risk. They're transitioning that towards a lower yield profile.
Okay.
And alongside that, the actual contribution from this older book to their total AUM is being intentionally reduced. So essentially, they're choosing to de-risk, build a more stable, high-quality portfolio for the long run.
Even if it means slightly lower margins right now.
Exactly. It's a strategic choice. Long-term stability over chasing those immediate high yields.
Right. So what does that mean for NIMs going forward? Do they expect them to bounce back?
They do. They expect NIMs to return to around the 9% mark.
Okay, and the timeline on that?
Within the next 3 to 4 quarters, so roughly 12 months. And the driver for that rebound will be scaling up these new, well-calibrated, and importantly, high-quality products that fit their target risk-return profile.
That makes sense. It fits the overall strategy. Okay, let's shift to operating efficiency. Pre-provisioning operating profit PPOP was 325 crore. Now that's actually lower than the previous quarter. Is that a worry?
Well, it seems largely by design, actually. That lower PPOP figure is pretty much a direct result of the ongoing, quite significant investments they're making in new businesses.
Ah, okay. The expansion costs.
Right. And also a strategic skew towards their secured loan book. Now, secured loans, while they're lower risk and fit the philosophy, they generally have lower yields compared to unsecured loans, so that impacts PPOP in the short term.
But they're still investing heavily.
Oh, yeah. Despite these big investments, they increased their employee base to nearly 4,700 people, expanded the branch network, their OPEX to average AUM ratio stayed impressively stable at 4.8%.
That does suggest pretty tight control even while they're expanding aggressively.
It shows strong operational discipline, yeah.
I also noticed their cost of borrowing dipped slightly, down to 8.04% from 8.07% last quarter. In this kind of rate environment, how are they managing that?
Well, they're being quite strategic about optimizing their borrowing mix. The share of non-convertible debentures, NCDs, in their total borrowing, that jumped significantly. It went from about 7% in March 2025 to around 24% by June.
Wow, quite a shift.
Yeah, and they raised another Euro 1,000 crore through NCDs in July, too. NCDs often give you more stable long-term funding, potentially at better rates.
And they have a target for that.
They do. The long-term goal is to get that NCD share up to 35%. So this disciplined funding strategy, plus, achieving the highest possible credit rating AAA from both CRISIL and CARE ratings.
It definitely helps.
Absolutely. It underlines their financial health and their ability to get diverse, cost-effective capital.
And speaking of strength, their capital adequacy ratio, CARE, looks very healthy. 20.55%, with Tier 1 at 19.02%. That's comfortably above the 15% regulatory minimum.
Well above. Plus, they've got a strong liquidity buffer, too. 4,465 crore as of June end ensures they have positive cumulative mismatch across all time buckets.
Right. Which brings us neatly back to that risk-first approach in action.
Yeah.
How did it actually play out in their asset quality numbers this quarter?
Very effectively, it seems. The metrics stayed remarkably stable, which suggests tight control. Gross NPA held steady at 1.84%.
Okay.
Net NPA also stable at 0.85%. And their provision coverage ratio, PCR, stood at 53.93%.
So holding the line despite growing fast.
Exactly. That kind of stability, especially when you're expanding rapidly, really speaks volumes about their underwriting and their collection processes.
Though this is where I think we hit a really interesting point, maybe that aha moment. Their overall credit cost as a percentage of AUM, it actually dropped quite a bit, didn't it?
It did, significantly, down to 2.61% from 3.14% in the previous quarter. That's a 53 basis point reduction. But as you say, there's an even more specific highlight within that.
Yeah, what was that again?
This is crucial, I think. They gave a new disclosure for their 12 core products, so specifically excluding that legacy STPL book we talked about.
Right.
The credit costs improved to an astonishing 1.43%.
1.43% on the core book.
On roughly 80% of their risk-calibrated AUM, yes. Now, that's not just good. 1.43% on that size of quality book is considered almost banking level in the industry.
Wow.
It really suggests, fundamental strength in their lending model, effective risk spotting, disciplined collections. It could genuinely set them apart from their peers if they sustain it.
And lead to better profitability as they scale.
Potentially, yes. And another indicator, their first EMI bounce rates improved by over 25% compared to the last quarter. That points to strong initial underwriting.
So that risk-first idea isn't just talk. It's really showing up in the numbers, improving the bottom line. What about that legacy STPL portfolio then, the one they're winding down? How's that being managed?
They're successfully reducing it. It went from 8% of their total on-book AUM back in March down to about 4% by the end of June.
Okay, nearly halved its share.
Exactly. And the credit cost specifically for that higher risk book also came down sharply, from 137 crore in Q4 FY25 down to 64 crore this quarter. That's a 53% reduction.
So they're managing the runoff well.
Seems so. They consider it adequately provisioned now, and they expect it to completely run off over the next 7-8 months. So it's effectively removing a drag from their overall figures.
That's clear, proactive portfolio management. And you mentioned their risk framework earlier. It sounded quite comprehensive.
It is. It covers credit risk, operational risk, fraud, infosec, regulatory, liquidity, the whole gamut. And they're leveraging analytics and tech extensively across all of it.
Which leads us nicely into their business expansion and product momentum. Where's the growth coming from now?
Well, the strong AUM growth is actually pretty well diversified across their products, which is generally a healthy sign.
What's the mix look like?
MSME lending is the biggest chunk at 36%. Then loan against property LAP is 25%. Personal and consumer finance makes up 23%. And pre-owned car finance is about 13%.
And the existing segments are still growing well.
Oh, yeah. LAP, for instance, grew a huge 128% year on year and 22% just in the quarter. Business loans were up 57% YOY and 10% QOQ, so the established stuff is still firing.
But the real strategic push seems to be around the businesses they've launched more recently, right? Since about August 2024.
Absolutely. They're really pushing hard to diversify and tap into new market segments. The momentum there is quite something.
Give us a few examples. What's taking off?
Okay, well, take PL Prime, that's their personal loan product. Launched just in March 2025. They call it an industry-first PL Prime Digital 24/7.
Fully digital, always on.
Seems so. And it's already showing healthy growth. Over 300 core dispersed in June alone. And interestingly, it seems to be attracting financially stronger profiles, like white-collar employees from top companies.
Okay, what else? Gold loans.
Yes, gold loan. They've moved fast there. Launched 80 branches already across Gujarat, Haryana, Rajasthan, Maharashtra.
80 branches already.
Yeah, and they're aiming for 400 branches by March 2026, focusing particularly on Tier 2 and Tier 3 cities. They dispersed about 31 crore in June from that.
And it's not just loans, right? They're into consumer durables now, too.
They are. Consumer Durable Loan launched in April 2025. They're already live with over 3,000 dealers in about 160 locations.
Wow.
Acquired 15,000 customers already, dispersed 34 crore in June. They've even introduced a PIN EMI card for convenience.
Okay. And commercial vehicles. Education.
Both showing traction. Commercial vehicle loans started in March 2025. They dispersed 47 crore just in June. And they're now expanding focus to include new CVs, not just used ones.
Right.
Education loans launched mid-March. They've logged over 4,000 applications, onboarded about 100 partners like education consultants, and they're pushing an industry-first digital instant sanction there. It's clear they're really leaning into what they call their phygital distribution model.
Digital, right.
Yeah.
That blend of physical branches, feet on street, partners, and digital website app aggregators.
Exactly. It seems key to this rapid expansion, being everywhere the customer might be.
Which I think brings us to maybe one of the most significant strategic shifts for them, this AI-first approach. They're calling AI a key emerging strength. How real is this? Are they actually embedding it deeply?
It seems very real. Their commitment looks profound. Take risk in underwriting, for example. They're developing advanced machine learning, even large language model-based analyzers.
LLMs. For risk?
Yeah, for early risk signal identification, monitoring behavioral trends. They've even got something called a Part Cred Bureau Analyzer for sharper visibility into borrowing patterns.
Interesting.
And they're building intelligent agents to streamline document workflows, data entry. The goal is pretty clear. Higher accuracy in assessing risk, faster decisions, better turnaround times, and crucially, lower processing costs.
Which feeds right back into those improving credit costs we saw earlier.
Directly. It makes those numbers more understandable, doesn't it?
It does. How about on the collection side? That's usually very labor intensive.
It is, but they're trying to transform that too. They've implemented what they call a humanless field agent allocation system.
Humanless allocation.
Yeah, apparently it cuts the allocation time down from days to just hours, which means faster follow-up, potentially faster collections.
Right.
They're also using generative AI for insights, trying to get value from unstructured data, and working towards, quote, self-learning designs for optimizing collection campaigns. It's all about efficiency and effectiveness in recovery.
What really strikes me, though, is how broad this AI push is.
Yeah.
It's not just in lending and collections. You mentioned other areas.
It really is holistic, yeah. In HR, for example, they're using AI for talent acquisition, like a sourcing engine. They've got an ER governance tool to help automate complaint resolution. They're aiming for 0 clicks for HR tasks and 0 lag for query resolution.
0 clicks and 0 lag.
Yeah.
That sounds ambitious, but potentially a huge internal efficiency gain.
Huge. And in finance, they're developing bots for competitive analysis, automating payment ops, invoice verification. Operations is looking at auto knockoffs on matured contracts, re-KYC automation. Even admin is using AI for things like automating travel bookings.
Okay, so these aren't just pilot projects. It sounds like a deep, strategic commitment to using AI everywhere to drive efficiency and speed.
That's the impression, yes. A pervasive approach.
Well, it's probably no surprise then that they've been getting some industry recognition for this.
Right. Awards like ET Now's Most Innovative Organization of the Year 2025, the Express BFSI Technology Awards for Customer Experience, and a Technology Senate Award for AI from the Indian Express Group. It's strong validation.
Definitely. Okay, shifting gears slightly towards the end here. Governance and people, they mentioned ESG commitments.
They do. Briefly on environment, it's things like green infrastructure, energy efficiency, socially, supporting healthcare access, sports, and investing in their own workforce. And governance is about strong standards, financial integrity, ethical conduct, standard pillars, but they emphasize it.
And the leadership.
The board and management team are described as seasoned professionals with extensive experience, guiding the company with what they call the best governance standards, and the shareholding pattern reflects stability too.
That remind us of that again.
The promoter and promoter group hold that significant 62.46% stake, and there's strong participation from institutional investors, FIIs, mutual funds, insurance companies, AIFs.
Right, which underlines that stability and investor confidence of where they're headed.
Exactly. It fits the picture.
Okay, so let's recap. We've really peeled back the layers on Poonawalla Fincorp's Q1 FY26. And what we've uncovered is, well, quite a compelling story, I think. There's the strategic capital infusion, really robust AUM growth coming from both their established and their new products.
And that deep and clearly demonstrated commitment to risk-first principles, which, as we saw, is really paying off in their asset quality and credit costs.
Absolutely. And perhaps most notably, we've seen how they're truly embedding this AI-first approach into pretty much every facet of the business, from the core underwriting right through to HR, aiming for, really top-tier efficiency and precision.
So hopefully you listening now have a much clearer, more comprehensive understanding of their financial health, their pretty ambitious expansion plans, and how this cutting-edge tech is genuinely shaping their future and, frankly, their competitive edge.
Yeah, this deep dive really reveals a very clear direction for them, doesn't it? It's this blend of, well, aggressive growth, yes, but disciplined growth, rigorous risk management, and just relentless innovation, particularly with AI.
It does raise a fascinating question, though, for anyone watching the financial sector.
Go on.
Well, as companies like Poonawalla increasingly leverage AI, not just to tweak things, but to fundamentally refine their operations and expand their reach, how will this AI-first ethos change things? Not just profits, but maybe the very trust and relationships that underpin financial services globally.
That's a big thought. What new possibilities really open up when almost every interaction, every decision is powered by intelligent automation? And maybe more importantly, what does that mean for how we perceive value, reliability, even trust in the financial world of the future?
Something to think about, definitely.